Hello friends. On this episode of the Adams Chetwood video newsletter, I'm going to give you our market outlook for the next 6 to 18 months. And before I do that, I want to give you a little bit of a personal update. Many of you know that I was diagnosed with a very treatable form of cancer earlier this year. I think today marks about 9 weeks since I finished chemotherapy. And boy, am I very glad to be done with that and hope I never have to do it again. But thankfully, the doctors have given me a very positive prognosis, and Allison and I are very thankful for that. So thank you for your prayers and your well wishes. Many of you sent cards and emails and texts just to make sure I was doing okay, and I so appreciate that. But let me transition into almost a continuation of the market outlook that we put together in January, where we told you that the economy reopening and government stimulus measures were going to be a positive for the markets, and yet they might lead to inflation, and they could potentially lead to some overvaluation when it comes to equities. You can click on that video from our January market newsletter, and that really has come to pass. I think the International Monetary Fund, I'll put a chart in front of you that will show that the economy reopening has been a big boon for the U.S. market and for your portfolios. I think they're expecting U.S. GDP to be higher than 6% this year, which is a wonderful thing. And I know that the Delta variant may have something to say about that, so I'm going to put another chart in front of you from our research partners at First Trust that will show you that even though the number of cases of COVID has had an uptick recently and the number of deaths has had an uptick, they're nowhere near where they were at the beginning of the year or late last year. So for that, we're thankful. We're hopeful that you will continue to wash your hands and be careful and wise when it comes to mask usage, and hopefully we can keep those numbers down so that you can stay safe. But one of the other things that has had a stimulatory impact is all this government spending that we are doing as part of Keynesian economics. And I've told you before, it's a branch of economics that says if we could just get dollars into the hands of our citizens, they will spend those dollars and that will stimulate the economy. Well, as we told you in January, my business partner, Rick Adams, always used to say that Keynesian economics is sort of like spiking the punch at a party. It feels good for a while, but it does have long-term consequences. And namely, one of those consequences is inflation. And we've started to see that a little bit. I believe in the month of May, we saw inflation at 4.9%, and in the month of June, we saw it at 5.4%. Now, the Federal Reserve will tell you this is temporary inflation. It's a result of supply chain disruptions from COVID shutting down manufacturing facilities so that parts and ingredients for other products can't be made. There's a logjam, and that will normalize over the course of the next 18 months. And they may be right. That's a plausible argument. But if they're wrong, there are things that we are doing right now in order to protect you against inflation. And we will probably save that for completely other videos. So come back and we'll talk about the four most common ways to fight against inflation. But the other thing that this massive government spending has led to, and these stimulatory measures of keeping interest rates so low, that has led to some overvaluation in the markets. And I'll show you a chart here that's an updated chart of what we showed you at January from our research partners at JP Morgan. And you'll see there that right now, the United States market, as measured by the S&P 500, is trading at about 21 to 22 times forward earnings. Whereas historically, over the last 25 years, we've traded at about 16 times forward earnings. Now, some of that can be explained away because interest rates are low. Some of it can be explained away because the economy is reopening. But we are, through a variety of different metrics, price to earnings, price to cash flow, price to book, dividend yield, we're about a standard deviation and a half above where the market has usually tracked. And that causes us to want to be a little bit more cautious. So for our clients, the good news is when we talk about our financial stress tests that we've run for you, we have put your nest egg through 1,000 different simulations, somewhere the market is overvalued and somewhere the market is undervalued. And we've shown you that regardless of what happens in the market, you should be well on track in order to achieve the goals that you've articulated to us. We really believe that that's one of the greatest value adds that we can provide you is, yes, to give you some commentary on the markets, but really to give you the confidence that regardless of what happens in the market, you can still do what you want to do when you want to do it and not have to worry about money. That, my friends, is one of the primary ways that we guide clients to financial peace of mind. Thank you again for all the well wishes and have a great day.